Hello. This screencast will address the inventory turnover ratio. This ratio is an efficiency measure for a business. A ratio too high can lead to very high storage costs, but a ratio too low can run the risk of having not enough stock to meet customer demand. As an example, Batman's Banana Shop wants to work out their inventory turnover ratio. For this, they will need two financial statements: the statement of comprehensive income to get the most recent COGS figure, and the last two financial position statements for the most recent and the time prior inventory figures. From there, we input the COGS figure, and we get the average inventory by adding the two inventory figures and dividing by 2. This should equal 38.06. To further this, we can calculate the average days to sell inventory by dividing 365 by the ratio, equaling to 9.6 days. But what does this mean exactly? Well, on its own, you can only make very general assumptions about a business's inventory by comparing it to either previous historic data or to a similar business. Batman's Banana Shop will have a much better idea on its inventory efficiency. When comparing to other businesses, you must first make sure that the business is a similar size and a similar industry as the first business. For example, holding perishable stock versus non-perishable stock can mean massive differences between ratios and will lead to false findings about the business. When a similar business is found, or using an industry average, we are able to compare Batman's Banana Shop's average days to sell inventory with the others, giving us the ability to make judgment if the ratio is better or worse. Similarly, looking at Batman's Banana Shop's previous data can also indicate improvements or deterioration in efficiency. In this example, we can see that the average days to sell inventory has risen in the last year period. If the average days to sell inventory has risen in comparison to previous data or is significantly higher than other similar businesses, problems may have arisen in the business. These could have been caused by external factors such as deterioration of demand for products caused by better competitors or perceived lower standards, or it could be internal causes such as lazy managing of inventory. In any case, managers must look into what is causing this problem and attempt to fix this before efficiency continues to worsen.